Share prices in London and New York have slumped dramatically following new fears about the state of the global financial system. The Dow Jones index closed at its lowest level for 12 years after AIG, once the world's largest insurer, announced the biggest quarterly loss in corporate history, $62 billion. Here, the British-based HSBC Bank says its profits have fallen by two-thirds, and the Ftse closed at its lowest since 2003. Here's our economics editor, Stephanie Flanders.
It was the day that investors around the world found reasons to sell. What spooked them in the US was the greatest corporate loss in American history. The global insurer AIG lost nearly $62 billion in the last 3 months of 2008. That's about $460,000 a minute.
The depth of the issues at AIG are far greater than I thought they were. But the economy is far worse than I thought it would be, and the capital markets are far worse. So the combination is kind of a hat trick. You know, it's a trifecta of difficult situations.
AIG is a lot more than 3 letters on a Man United shirt. It's active in 130 countries, insuring businesses and households to the tune of hundreds of billions of dollars. The US government thinks it's simply too big to fail. Since September, it's had $150 billion in government bailouts, and today it got $30 billion more.
It's effectively one of the bricks at the very bottom of the financial pyramid, and if you pulled that away, the whole financial services structure would effectively collapse.
The news from AIG helped send the main US stock index below 7,000 for the first time since 1996. By the end of the day, it was down more than 4%. Here in London, shares fared even worse. The Ftse fell to its lowest level since 2003, more than 5% down. The fall here was partly down to AIG, but this was also the day that our biggest bank put out a record-breaking number of its own. HSBC has weathered the credit crunch a lot better than most. It even made a profit last year. But even HSBC thinks it needs to raise £12.5 billion from shareholders to prepare for the storms ahead.
We've always stood out as having strong capital and strong liquidity. These are extraordinary times, they're very turbulent, they're very volatile, and I think it's right that we should make sure that our capital continues to be absolutely beyond question.
It's a sign of these extraordinary times that tonight some are questioning whether even $12.5 billion will be enough to see HSBC through. Investors had hoped that the financial sector was through the worst. Today they fear there's still more bad news to come.
Well, Stephanie, as you say, we're still no clearer, it seems, whether we're at the bottom of this recession. So are these big drops in share values, this kind of volatility, what we should expect to see in the market?
Yeah, and of course we shouldn't overdo it. There will be volatility, and we're not back to where we were in September or October, when people were genuinely fearing that the global financial system might collapse. But I think what you saw today is investors are disappointed that we're not further along in this crisis, that we haven't drawn a line under these problems. If you like, in a normal recession, this would be the stage where we knew what was going on in the financial sector, and investors would be looking to which parts of the economy might recover first and looking to invest in those areas to benefit from the recovery when it happened. Instead, they're having still to worry what's going on inside the banks, inside these big insurers. They haven't been able to move on from that. And I think people hoped, in particular, that the Obama administration would come in with a big forceful plan for the banks and for the whole financial sector and would have allowed people to move on. They haven't done that yet. And I think until they do draw a line under those problems, we may well have more days like today.
Okay, Stephanie, thank you. Scotland is set to become the first country in Europe to have a legal